Lee Munson of Portfolio Wealth Advisors. Hey there, Lee. So usually I like to ask you what you're buying, but I'm going to start and ask you, have you been selling anything the last couple weeks?
No.
No?
Why would I do? I mean, I guess if I was selling bonds to buy stock, which I did back on October 26th, and you could do that last week too, but why would I be selling? Because that would be a form of capitulation. I want other people to capitulate so I can buy their shares, right?
Okay.
But it's easy for me, it's easy for me to say that because most of the portfolios that I run for clients, they always have some bonds in it. Mm-hmm. So it's a lot easier for me to say that. If you're in all stock, you're kind of screwed. What are you going to do?
Lee, Miles here. I'm just curious what you make of the general market action that we've seen over the last couple of weeks. It's been about a month since we've talked to you. A lot has gone on since then. Really, the last 7 trading days have shown this propensity to open up or down and then completely reverse that move throughout the trading day. And as we're seeing today, then re-reverse that move. And it just seems like what's head is tails and tails is heads.
Oh, I love it. This is the best time because I can get back to clients. I can do a lot of skiing as I was doing last week and intend to do next week. When I was a day trader, this is what everybody wishes for, these big swings. And if you look at the S&P and you go out maybe to the last maybe 6 weeks, or take a year-to-date chart, you'll see this, what we call kind of banging on the bottom thing, but it's not really going anywhere. Yeah, that's what I'm talking about. Now look over at that chart to the right-hand side. See, you can see those 3 little points there. And everybody wants to talk about, well, is it a higher high, is it a lower low? A lot of technicians are kind of up in arms about this. And I would say that all that's happened here is nothing. We're still higher than we were the first week of February during the VIX mini crash. The S&P is not lower than the lows we got back in February in the first half of this year. So from that perspective, why would I be selling? But also, why am I buying the S&P this way? I think it was best said, in the last couple of weeks, Paul Tudor Jones, who, by the way, is like my hedge fund idol, a Southern gentleman who drinks Budweiser and looks at charts. I had this vision. He wears this white suit every day, which he doesn't.
He doesn't.
Paul Tudor Jones said it best and most eloquently, which is next year he sees the markets overall either going up about 10% or down 10%. And this little chart is telling you why. Because we have too many things that are negative, but we have too many things that can surprise to the upside. So now that we're at the bottom end of the range, right? And I'm just looking at the year-to-date range. What could possibly happen? We've got housing that we know looks horrible. And by the way, if people don't think housing is horrible, it is. But it's not as bad as it was in 2008. We don't have as many loose lending standards as we did 10 years ago. And so it's very easy for housing not to become a disaster and have it increase consumer confidence. The second thing is rates itself. With interest rates, I mean, come on. We have this opinion that the Fed, that they're morons, and they're just going to do something bullheaded and ruin everything. I even remember that guy, that Jim Cramer guy, right? A couple weeks ago, a week before the Fed said, we may not raise rates because we see what's happening in the economy because we're not morons. We get a lot of the good data. He was telling people, if you think the Fed's going to raise in December, you should just sell everything. Okay. Well, we know what the Fed's going to do in December. That's a stupid thing to tell people, and I think it's negligent, and I said it, and I'm not the first to say it. So I think that the idea that the Fed might pause because of what's actually happening is a surprise to the upside.
Hey, I got to let our Fed expert jump in here, Brian Chung.
Hey, Lee, Brian Chung here, and I feel you could just drop the mic right after that, but hey, I got to ask you, as you mentioned, you looked at that chart just now, it looks like year to date, we haven't really moved all that far, despite that huge jump and then the decline that we had, but it's a different story if you look at the VIX, right? Are you just trading off of volatility here?
Well, you want to trade off of volatility. If we can get a volatility chart for all the watchers out there, think about what happened in February. Why do you think I bought? Because when I see the VIX go from nothing, look at that. How am I not supposed to buy? My clients who are all basically retired women who are weapons designers or artists, that's kind of like my thing out here.
New Mexico.
They would fire me if they said, New Mexico, baby, New Mexico. When it spikes that much, you've got to be a buyer. And so look at it right now. It wants to go higher. It wants to surprise. But as soon as you see that VIX getting closer to like 30, that's when you know there's capitulation, and that's when you start getting greedy and look for blood on the street. So I hope I answered your question about the VIX. I think the VIX is very much going to be a key indicator next year to inform me about where I want to pick and choose. And it's that last thing I need before I pull the trigger. It's a one little thing I really like to see high before I buy.
Lee, so a lot of our investors are long-term investors, people that watch.
So they say.
And so they say. And they're watching everything that's coming out of DC. They're on Twitter seeing what the president says. They watch this meeting in the Oval Office today. And people want to know, should they be trading off of what happens with President Trump and Congress, or should they just turn off the TV? Don't turn off the internet in this show, but do they need to be paying attention to this? Do you, as a trader, as an investor?
I mean, I usually look at the news I don't know, on the weekend.
So no,
I
is
try
what
to
you're
read.
saying.
I read The Economist front to back on Mondays after it comes out on Thursdays, because I find that more insightful. Here's what I'm looking for, though. The reason you don't want to turn off your internet is because if one of these things gets down to the level that you want to buy. So for instance, I'm looking to be a buyer for my clients if the S&P is in the 2,500 range. Boy, it's really close right now. Mm-hmm. So if I were to see 2,500 or 2,520 on the S&P, then I'm more likely to want to be buyer if I see a high VIX and I see these stupid news stories. So I want to see Trump said something really weird that rocked markets, and then it's at my levels. Okay. Or everybody can't get out of their way about iPhone sales, and if Apple doesn't do well, the market can't move forward. So I think the news is important, because what you want to see is a volatile news story that isn't news at all, like decline in oil prices, not news. The Fed, not news. Apple iPhone sales, not news. And you want to see that news push the market down to a level that you know ahead of time. So instead of letting Trump decide when you're going to sell, Trump might create the situation that brings the S&P down to 2520 that I'm going to buy. So I think the news is important. It's fun. It's entertaining. But the news itself isn't important. It's where it drives the market, because when news gives a surprise to consensus, money is made and lost.
All right, Lee Munson, thank you so much. Portfolio Wealth Advisors, looking at the S&P right now, just around 2637. Not quite at your level, but I'm sure we'll be back and talk with you again soon.